Welcome to our weekly market review. It's brought to you by ETM Analytics and TreasuryONE. As per usual, I'm joined by currency strategist at TreasuryONE, André Cilliers. André, it is the 9th of March, 2026. We're barely 3 months into this year and the world is on fire. The oil price continues to spike as the Middle Eastern conflict continues to rage. We're in our 9th or 10th day, I think. Just because the Strait of Seaway is 39 kilometers wide, remains effectively closed for 20% of the world's oil supply. Now, I'm not one to get alarmist, but it feels a little bit like we're staring down the barrel of a gun here, right? I mean, if this trajectory continues and the oil price continues to spike, I mean, we're looking northwards of 100, 110, perhaps even some saying $120 per barrel for oil, and which ultimately is going to make everything effectively come to a standstill globally if we hit those kind of levels. So this is a serious situation that we're finding ourselves in.
Yes. Good morning. Okay, so when we spoke last week on Monday, the war was already on, but the reaction in the markets was kind of subdued. The rand went up to 30, it came down to 25, hovered around there, not much. So it was a very subdued reaction. On Tuesday, we saw major moves coming to light. Yes, the war did escalate, but the war is still just actually waging on. What happened on Tuesday? People started realizing the economic impact of this war. The economic impact because of oil, the supply of oil, the logistics surrounding oil, the Strait of Hormuz, etc. And that leads to much higher inflation, lower growth, possible changes on monetary policy by central banks, lower world growth, and so forth. So the economic effects then turned nasty because people realized that, and we saw stock exchanges tumble, we saw oil prices going further, everything just changed and currencies moved a heck of a lot more. And it's a week later and we're still in that economic impact of this war. So the focus now is, where is things going? And I read yesterday that if you look at an oil price of around $80 per barrel, that you're looking at somewhere between 0.7 and 0.9 percentage points added to inflation, around 0.2 to 0.3% lower in terms of world economic growth. We're trading at $115, $116 per barrel. So that means you are now most probably looking at 0.5 or 0.6% of world economic growth. You're most probably looking at 1.5 or 2% added to inflation. That's a definite change to the trajectory of interest rates and what central banks will be reacting to towards their monetary policy. And as they react on monetary policy, that could escalate matters even further. And now there's a new Ayatollah that was announced, the son of the deceased one, is now taking over. I doubt whether that would please Mr. Donald Trump, and he specifically said that he wants to be known as to who gets elected as the new leader in Iran. So nothing so far, to me, points to a lowering of the impact, a lowering of the tension in the Middle East. It escalates further in the sense that energy supplies have been targeted over the weekend. Desalination plants has been targeted. Airports are targeted from other Middle East countries. Hotels are being targeted. So civilian targets are now being targeted in this war. So this is really actually very negative. On the other hand, you have China sitting on the sidelines, and we're not hearing too much out of them. I doubt whether they're very pleased with what happens in the world. So at this point in time, as I say, nothing points to a lowering of the tensions, just an increase in tensions rather than anything else. So we should really be concerned, but I think more concerned about what's the economic impact for us here in South Africa and how it will be influencing the consumer and consumer spending and fiscal income and what the Reserve Bank can do in terms of.
I put out a piece last week as well saying that, the higher dollar price might very well be the thing that pushed Trump to a negotiation table, even though he might not agree with the kind of remnant of the regime remaining in Iran. We all know that it goes against all of his campaign policy promises that he made. We'll remember that he wanted lower oil prices so that there will be low inflation, so that capital will be cheaper. So Iran strategically in that sense made a very smart move. So I see, what could potentially happen is that could happen where the oil price gets to such a level where it kind of forces Trump to some form of cease agreement or negotiation. Or we could see a very rapid intensification on military action on the ground in Iran through ballistic missiles attacking these strategic areas of the remaining Iran regime to kind of force them to eliminate and get done and move on with. Either way, within the next week, I think it's going to be a defining moment on which direction that this conflict is going to go into. The kind of more moderate scenario could possibly be something that we see, as we've seen now these regional attacks happening, that get a lesson so that the conflict becomes almost contained just within Iran. But then again, you only need one person with one missile to fire at a oil tanker in the Strait to keep risk premiums where they are and increase insurance on these companies so oil prices remain elevated in any case. So this is kind of the difficult situation. And I'm watching out for Russia, who is obviously smiling at the moment. We know that the US lifted some of the sanctions on their oil, so everyone is going to turn to them for cheaper oil, or at least supply of oil. And then, yes, you're right. We're watching what China is doing. China has been very careful in their wording. They've asked the Iranian regime to at least allow some of the ships coming to them to go through the Strait of Hormuz. We also know that China has been storing up a lot of oil, right, in recent years, along with gold and LNG. So they're playing a very diplomatic stance at the moment because Iran is a strategic oil supplier to China. They might very well suggest that they enter into a kind of mediator role in this as well, so they have some say in what comes after this. But they're still very adamant to meet with Trump this month. Remember, he's traveling to China to meet with Xi Jinping later this month. So I would love to be a fly on the wall. But definitely serious economic implications. Our sister company, Econometrics, they've actually put out some research this morning. If the Rand continues the way it has been over the past week, depreciating obviously quite rapidly, given the situation, and the oil prices increase, we might very well be in for a 3 Rand increase in fuel prices, which could push our inflation northward of 4%, which means all interest rate cuts that were priced in before this war is effectively off the table, right? And we're obviously not the only one with this problem. The US is also concerned because, André, you and myself have spoken so many times that the Fed is still trying to get back to the 2% inflation target level. They've been struggling to do so. There's been a strong focus on the labor market weakening, but this might very well shift the Fed's focus back to looking at inflationary risks and upwards pressure coming from the oil price, right?
Absolutely. If you look at what's happening here, it's the cost of energy that will go up. The cost of energy is not something that's unique to a specific country. It is specific to every country. It is specific to hitting inflation. Inflation is specific to hitting monetary policy. So it will have an impact on what the Federal Reserve makes decisions on. And at the upcoming meeting and our upcoming meeting, the concerns would be raised surrounding the cost of energy, the cost of fuel, and so forth. And hence people will sit on the sidelines and not lower interest rates at all. And chances are becoming more on the increased side that it will be rising interest rates if this continues for a long time. If you look at the rand and what the impact could be on the rand going forward, and Michal can put up that graph for us, then at this point in time, we have a little red line and we have a green line, and we have the conversions of these things getting closer and ever closer to where the rand is actually trading, and that's our moving averages. And if you start getting closest below or above that, then that could have an impact technically on where the rand goes. So, everything is being driven here into a corner, into a tight spot, with big moves, with big risks, determined by what happens between Israel, Iran, and America. And to try and analyze what's going on there is a bit of an exercise in futility. The best one can do now is to actually focus on the risks of big moves in terms of currency, in terms of interest rates, and so forth, on you as a company, on you as a human being, on you as a household with an income, and start looking at how do I mitigate my risks rather than try and sit and analyze who's firing the next missile.
I know you guys also have a lot of clients linked to farming, and we always speak of oil, but keep in mind that a third of the world's fertilizer ships through the Strait of Hormuz. That is a significant amount. And fertilizer is not like oil; you can't store it up. You can't keep reserves of fertilizer. So, and that will ultimately also play into food inflation. So, yeah, it's going to be. I think anyone, like you said, it's you can't really speculate because I don't think anyone is exactly sure of how this is going to play out. But one can hope that this will be resolved fairly quickly, at least in a regional and global stage, especially given South Africa doing so well. We were on such a good run trend, and it kind of just feels like everything just came unstuck very quickly because of this. So we can just hope that this will just be a medium term, at least, risk, so things can bounce back very quickly. But André, I think we will chat again next week, and I'm sure there will be new developments for us to look at and consider going forward.
I'm sure of it that there will be. Enjoy your week and go well.